SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF-BAFFI Bocconi e-lecture on key insights from the IMF's October 2025 World Economic Outlook, Global Financial Stability Report, and Fiscal Monitor. The global economy is adapting to policy shifts, including on trade, amid persistently geopolitical tensions and high uncertainty. Technological advances, including fast advances in AI, are reshaping our economies. Slow-moving challenges such as aging, but also climate change, are getting closer to tipping points. How do these forces shape the outlook for growth and inflation? What are possible scenarios? What does this mean for public finances and the financial system? What risks are there for fiscal sustainability and financial stability? How should policies respond, especially when policy space is already depleted? The latest trio of IMF flagship publications, the World Economic Outlook, the Global Financial Stability Report, and the Fiscal Monitor, was released 2 weeks ago. It sheds light on many of the questions just mentioned. Today's e-lecture brings together the lead authors for key messages. Let me give a warm welcome first to Deniz Igan, Chief of the IMF Research Department's World Economic Studies and SUERF's Vice President. Deniz will highlight key findings of the latest WEO. Then, Jason Wu, Assistant Director at the Monetary and Capital Markets Department of the IMF, will present key findings from the GFSR. Third, Davide Furceri, Division Chief at the Fiscal Affairs Department, will explain to us key insights from the Fall 2025 IMF Fiscal Monitor. Now let me hand over to Deniz. The headline of this WEO is Global Economy in Flux, Prospects Remain Dim. Deniz, what are the main takeaways?
Thank you, Ernest, and thanks everyone for joining us. Since our last report in April and then our update in July, we continue to see much action on the policy front, shifting policies, as Ernest was talking about. And tariff news continue to dominate the headlines. And we have started to see what the new equilibrium as far as U.S. trade policies, U.S. tariffs are concerned is going to look like. So what you're seeing on the left-hand side is the U.S. tariff levels, different times. So the blue dots are the end of 2024, and then the other colors are showing you how in our different reports in April, in July, and our current report in October, these rates have been shifting. And what you can see is that for most countries, we are seeing a settling of the yellow and the green dots, somewhere in the range of 10 to 20%. They are lower than what were assumed in our April report. Those are the red dots, but they are still very high compared to where we were at the end of 2024, the blue dots. So that brings us to the left-hand side, right-hand side chart, basically showing you that trade policy uncertainty, that's the yellow line. It has come down from the peak we had earlier in the year, but is still historically very high levels. And at the same time, broader uncertainty, which Davide and co-authors have constructed, that's the blue line, remains as high as the index goes. And that reflects not only changes in the trade policy domain, but also other policy domains where we're seeing quite sizable shifts. One is the development aid. So there are sizable cuts we are observing as announced by major donors. And that has implications, obviously, especially for low-income economies. And we're also seeing more restrictive stances on immigration in several advanced economies, which has implications for labor supply in advanced economies, but also for remittances and growth in the source countries, which tend to be more emerging market, low-income economies again. And last but not least, we have observed a shift to more stimulative fiscal stance in major economies, and that raises both concern about the lack of adjustment toward more sustainable fiscal stances and more volatility in financial markets, as Jason will talk about. So with the setting being one about uncertainty, one about big shifts in policies, how has the world economy held up is the main question. What we have seen actually in the first half of 2025 was quite resilient activity, but this reflects in large part the trade-related distortions. So for major economies here, United States, Euro area, Japan, and China, we're plotting the quarterly contributions to GDP growth. And let me get your attention quickly just to green bars. These are net exports. And how you can see in the first and second quarters, they had this mirror image, especially in the US Q1 net exports subtracting sizably from GDP growth, and then adding that back in Q2. And the mirror image of that you can see in particular in China, but also in other economies, and that is related to the front loading of activity, front loading of consumption and investment in the US ahead of the higher tariff rates, which I'm going to keep talking about this front loading activity hiding other type of weaknesses we're seeing in the global economy. So next slide. As I said, we have seen this resilience actually in the first half of the year. On a quarterly basis, the growth we have observed was in the 3.5% range, which is quite respectable. But confidence continues to remain low in many economies. And you can see consumer confidence in China has collapsed in 2022 and has still not recovered. Similarly for business confidence, and other economies are not that much different, especially when it comes to business confidence. And this is all related to uncertainty that I talked about. Now, next slide, please. Let me take a little bit of a deep dive into the uncertainty aspect, right? Because the first half of the year, I argued so far, the resilience we have seen is mostly related to trade-related front-loading of activity. And the question you may have in mind is that what to expect in the second half of the year and in 2026. Our assessment is that we're going to see more negative impact of uncertainty being realized in the second half of the year, perhaps into 2026. And we have a small, toy model in the report that is illustrating why we might expect this type of delayed impact of uncertainty. And what you're seeing is, in this simple model is you do have a shock to uncertainty. It's not a tariff shock, but it's a tariff uncertainty shock. And what happens is that you get this front-loading effect in this, even though it's just a quite simple model, you do get the front-loading effect. If you just look at the left-hand side, you do see the increase in output and imports, and then the decline that comes later in the later quarters, and the overall impact remains negative. And we do anticipate that to start being realized later in the year. If you turn to inflation was the other thing that we haven't quite seen the type of expected pressure in the tariffing country in the US. And in other countries, we're anticipating more, disinflationary forces or stable inflation, which got realized much more. But again, in just focusing on the tariffing country, this model suggests that you would anticipate to see an increase in inflation, although it's not, it's not a very large impact. But this can again be delayed, and in the dotted line, you're seeing this uncertainty shock being delayed. So today, you know that there's going to be an uncertainty shock related to, for example, negotiations. You pause tariffs today, and now you continue to negotiate with your trading partners. And what the model is suggesting that the impact on inflation, that's the dotted line, then would be smaller initially, but would be much more persistent. Next slide, please. So speaking of inflation, as I said, we have seen globally stable prints so far. What is interesting is the third panel here on the right-hand side is the core goods inflation, and you can see the blue line, which is the US, ticking up, while we're not seeing that similar force in other economies. And we take a deeper dive, next slide please, deeper dive into the US case, and what we are arguing in the report is that there's again some delay in the inflation pass-through from tariffs in the United States. Why is that? In the left-hand side, we are plotting the effective tariff rate over time for the US, and that's the blue line. And the red line is the actual tariffs. So this is the duties collected, customs duties collected in percent of value of imports. And you can see there's a lag between the two, right? And this is coming from several aspects. One is that the effective tariff rate is calculated based on trade weights before tariffs as of 2023. So obviously firms and consumers are going to shift. They're going to substitute higher tariff goods for domestic or lower tariff goods alternatives there, and part of the discrepancy between the two lines is reflecting that. But the other thing, that the delay, the jump not coming as fast as you think, is of course related to the pauses that we have observed, but also related to what firms, businesses have been doing, the tactics they've been putting in place in order to navigate this new tariff landscape, using warehouses, managing their shipments in a different way, so that the impact is not fully realized yet. And you can see that when you do the more granular analysis of how U.S. consumer prices have been behaving, you can see that there is some pass-through overall for core goods. We have seen probably 50% of what you would have anticipated, but there is much more in the pipeline that we will likely be seeing, because this type of tactics are not going to last forever. Next slide, please. So another thing that's related to the pass-through is how the dollar has been behaving, right? And the U.S. Dollar depreciating since April actually undid some of the impact that we would have expected to see, and that's quite unusual compared to what has happened in 2018, which the first chart is showing you. And again, interestingly, ex-tariff prices, before tariff import prices to the US, if you look at 2018, we have seen some decline because importers absorbed some of the cost of those tariffs. We're not seeing that in the current episode. So import prices barely moved in the US. Now, that's not to say in certain sectors we're not seeing this type of absorption. The last graph is showing you the Japanese export price for passenger cars. And you can see that the Japanese importers reduce the price on their exports to North America, but they have not for the rest of the world. So they're absorbing some of the shock so far. We don't see the similar price change for South Korean exporters, for example, or German exporters. So this type of competitive pressures and strategic thinking is going to come into place, and we don't think that's going to last. Next slide, please. Another way to look at is, of course, on the trade side, how the volumes have been behaving. And we again did a comparison of 2018-19 episode to what we are observing today. And the main takeaway is actually is that, so if you look at the solid lines, those are 2018-19 exports from China, exports from the US. And you do see the decoupling, the blue lines between, China to US and US to China flows collapse at some point, right? And then there is diversion to other regions. Now, if you look at the dotted lines, we are seeing this decoupling between US and China flows happening much faster than what we have observed earlier. Trade diversion effects are not yet as visible, but again, if you look at some sectors, you will see it there. Next slide, please. And as I said, the comparison in terms of geographical rediversion of trade is different in this episode than it was in the past. So in the first part, you're seeing the first chart is showing the exports from China, and we have seen the green column that's showing the Asia Pacific, so exports from China to other Asian economies, that picked up this time as well as it has done in the past. But you're also seeing in the 2018 episode the red bar, which was the USMCA, so Mexico and Canada. They were picking up part of the flows from China. This time we're not seeing that as much. And the reason we think this is happening, which is related also what to anticipate in the rest of the year in 2026, is that first, the 2018-19 episode had China as being the main part of the tensions, if the only one, right? This time we're seeing a more universal increased tariffs from the US side. So it's not clear for firms, if you don't buy from China but you buy from Vietnam, you have a clear advantage. The advantage is still there, but it's not as clear as it was in 2018. Another reason we think is happening, especially with the USMCA countries, not getting as much diversion this time, is related to the fact that there are other non-tariff measures that are limiting what can be done, transshipment tariffs and country of origin rules, other restrictions on FDI. So those stricter enforcement and threats are like limiting what firms can do there. And last but not least, the uncertainty that I mentioned, given how high uncertainty is and it's non-linear effects, we're probably going to take some more time until we see a full reconfiguration of supply chains. Next slide, please. So I'm going to talk about fiscal very briefly, passing on to Davide on that one. But as I mentioned at the beginning, fiscal policy remains loose in many large economies. And we have seen so far some short-lived spikes here and there, but it is getting more and more concerning in a more medium-term, longer-term perspective, how much this higher interest rate, high debt, high deficit combinations is going to work out in financial markets. So next slide, please. With all this, why do we call it dim prospects? Next slide. So for our forecast this time, we don't have much of a change in our basic assumptions. I mentioned what we're assuming on the tariff rates. They are lower than they were in April, pretty much the same for July for most economies. But commodity prices, we haven't changed much. If anything, energy commodity price assumptions, they are lower than we had in April. Monetary policy didn't change much. If anything, for the US, we are expecting a little bit, slightly more overloaded, front-loaded lowering of interest rates. It's fiscal policy where most changes compared to what we had before is happening. You cannot quite see that, but for the advanced economies, we now have an overall neutral as a group. But in certain economies, US, Germany, China, we have a more stimulative stance than we had in April. And that is making a difference in terms of creating an offset of all the negative effects that I talked about. Next slide, please. So we're taking all this into account, where do we stand? Things that for the world in 2025, we are projecting 3.2% growth. And for 2026, we're at 3.1. Now, compared to July, we actually have revised up our forecast for 2025, and we haven't changed it for 2026. This upward revision is reflecting what I talked about at the beginning. It's the front loading, it's the data. The first half of the year came as strong as we thought. But this is not to say that tariffs and uncertainty have not had a negative impact on our forecast. The way to see it is that take a step back and go to October 2024. A year ago, we were anticipating for 2025, 2026, we were expecting 0.2 percentage point higher growth. So the effect is there, it's delayed, it's masked by other forces, but it is happening. Next slide, please. So for emerging markets, it's a relatively stable outlook, but just to get your attention to China, we are forecasting 4.8, and if you look at our history of China growth forecast, it has pretty much followed what has been happening with US tariff rates. We lowered it to 4% in April, we revised it up to 4.5, and now we're at 4.8, which is the same as or very similar to what we had in October. But the offset here is important to mention. And the dim prospects is coming from the fact that for 2026, we are forecasting only 4.2 for China. Next slide, please. And just to summarize, I mentioned the October 2024 being a benchmark. So those are the red bars in these charts for growth on the left-hand side and inflation on the right-hand side for different regions of the world. And what you can see is that we were anticipating already last year some moderation in growth in the US and further disinflation. So negative bars, the red bars for the US compared to 2025, growth was going to be slower and inflation was going to be lower. You look at the blue bars, so what we are anticipating today is that for the US, we are anticipating the slowdown in growth to be even more pronounced and inflation barely moving. So it's this almost stagflationary dynamics playing out in the US case. For the rest of the world, it's in what we are projecting is basically consistent with countries that are seeing demand shocks, and we have slower growth, but also inflation not being as inflationary pressures not being as strong as we would have anticipated otherwise. Next slide, please. So in terms of world trade, I'll mention it very fast, but we do so for 2025. The front loading basically is keeping world trade volume growth quite healthy. I would say we have some payback in 2026, but what's important is in the medium term, with the policy shift that we are seeing, we are anticipating world trade to GDP ratio to decline in our 5-year forecast horizon, and it's about 2 percentage points lower than what we were forecasting in our October 2024 report. Next slide, please. And continuing on this medium-term kind of outlook, we have a more fragmented international economic landscape. And if you look at our 5-year ahead GDP growth forecast compared to October 2019, before the pandemic, what we were thinking and what we are thinking today, and you can see most countries, you can see on the left-hand side, for most countries, we're below the 45-degree line, so it's lower growth than lower growth today than we were projecting in 2019. And if you look at different country groups, and this becomes clearer on the right-hand side, the percentage, there's a range, but what is interesting to notice is that the low-income economies on average are the ones that are going to be seeing much lower growth than we were anticipating before. And that's concerning because this type of convergence, catching up, we would anticipate is not happening. If anything, they are falling behind their advanced and emerging market peers. Next slide, please. So as usual, the other things in the medium term that's going to be affecting. So I mentioned low-income economies falling behind. In our forecast, in our baseline forecast, we are very conservative in terms of how official development assistance is going to be evolving. We have the cuts incorporated, and what is again concerning here is that most fragile, most conflict-affected economies are also most exposed to the changes that are happening on international aid and migration policy front. We're seeing, for example, you look at in percent of gross national income, which countries are most dependent. You can see, you know, Syria there, you can see Somalia. Those are economies that will be affected. What is also important to notice in the middle graph you're seeing is these economies have their revenues pretty flat. You know, fiscal revenues in percent of GDP have been flat. And that service, that's the red line, has been increasing. So it's going to put even more pressure on these economies that we are anticipating cuts in international aid. In terms of immigration, as I mentioned, this is going to affect both sides, both the destination and source economies. For AEs, you know, it's the labor supply shock, especially in aging AEs with less immigrants replacing retiring workers. That's going to be a supply shock in those economies, which the impacts can be quite large. But also on the remittances side, emerging Europe, for example, but also Sub-Saharan Africa and Latin America and Caribbean, those economies rely on remittances quite a bit, and they have a large stock of immigrants in those economies, and we'll need to see how that's going to affect them. Next slide, please. Next. So as usual, we have our risk assessment, and it's not going to surprise you, where we see the downsides, trade policy uncertainty continuing to remain high. We are assuming it's going to remain high throughout 2026, but if it lasts or we get additional spikes, that could affect our growth forecast on the downside. Labor supply, I mentioned. Fiscal and financial market fragilities, how they will interact with each other. That's something that we're watching very carefully. And let me just mention one thing here, because you're going to see the both on the downside and the upside. So the repricing of new technologies and the AI-related productivity growth boost. The way we're reconciling is that one offset to the negative impact of higher tariffs and higher uncertainty has also been this tech-related investment surge, especially in the US, but then you have the mirror image of that in Asian economies like Taiwan, like Malaysia, where they are, you know, main producers of semiconductors and other type of IT equipment. So this offset, positive offset, coupled with the generous valuations of this tech stocks, which I'm sure Jason is going to talk about, can be a short-term risk in the sense that it's a boom-bust cycle. It resembles a boom-bust cycle, and we can draw some parallels to the dot-com dynamics of the late 90s, early 2000s, and that is a downside risk to the outlook in the short run. In the more medium run, long run, if the artificial intelligence related productivity gains as anticipated are realized and as transformative as we think, then compared to our baseline, which is quite conservative on productivity growth, this could create an upside. Next slide, please. So again, referring to the our report, you can see various scenarios where we quantify the impact of these different types of shocks. Our scenario A is the downside risks, higher tariffs and supply disruptions, and inflation expectations shock relate to also the threats to central bank independence, possibly de-anchoring inflation expectations, higher sovereign yields and tighter financial conditions related to the fiscal financial market fragility interaction I mentioned, and a lower demand for US assets, which you can again combine or relate to the fragmentation and changes in policies and institutions that's going on. These would be all affecting the world economy negatively, and as a combined impact, we do think in the long run that could reduce world GDP by about 2% compared to our baseline. Next slide, please. And next. So as usual, what to do with all of these? Let me again pick on one thing. We do have our full suite of policies as usual, but we think what's going to be crucial is having the full package there. So we need to start with the predictability and credibility getting back on the trade front. Fiscal consolidation without further delay happening and debt sustainability being restored. Monetary policy with independence and credibility of central banks as the main pillar of macrofinancial stability, and of course calibrating to country circumstances because we're seeing different dynamics on inflation, as I mentioned. But it's also important that we have medium-term policies, structural policies being implemented, again, without further delay. And in that front, let me put in a word for our analytical chapters. One of our analytical chapters is looking at emerging markets resilience to risk-off shocks and finding that improvement in policy frameworks. So that's related to monetary policy, fiscal policy, and macro-financial policies has been a big contributor to the resilience that we have seen in emerging markets. And our other analytical chapter is looking into the role that industrial policies can play. And the main message, main takeaway there is that industrial policies should be handled with care. They can be very costly, they can involve steep trade-offs, and there are better options on the table in the form of horizontal structural reforms. So let me stop here and pass on the word. Thank you.
Thank you very much, Deniz, for this very rich presentation, which of course just shows a small part of the WEO, but I think you made a number of very substantial points. Let me maybe start out with 3 short questions to you. We have 10 minutes for Q&A, so if anybody wants to put questions in the chat, please feel free. I will start with 3. First, your growth outlook for both emerging and advanced economies is quite subdued. Does this, in your assessment, reflect more structural dampening of potential growth, or is it cyclical, temporary? Second question, is the inflation effect of tariffs dampened, I could also say distorted, by the simultaneous US-led, but ultimately global stalling or even reversal of climate protection, which lowers in the short term the cost of energy, as you showed in one of your slides? And the third question is, you call for a full set of policy actions in the last slide. You certainly got a lot of feedback during the IMF meetings. What was the feeling there? Whether this set of policy recommendations has a good chance of materializing, what conditions would need to be met for them to put into practice?
Great set of questions, as usual, Ernest. So I'll be quick. So on the subdued medium-term prospects, growth prospects, we do think that's structural. It's not cyclical anymore. As I said, we were anticipating a slowdown in the US and some recovery in the euro area, in Japan. So those are happening, but it's the structural forces that's holding back growth. And just mention China, we're seeing real estate sector slump continuing to weigh on activity, coupled with demographics coming in, an aging population, and now with the headwinds coming from a more challenging external environment. So those all will be weighing on growth, and similarly for many regions in the world, it's much more structural, I would say. And on the inflation impact, that's an interesting question. And actually, commodity prices, oil prices being quite subdued in the 6 to 7 range, even with a short-lived war in the Middle East region. That has been a boon for many economies, especially on the inflation side. We haven't done much analysis, I must admit, linking it to the policies on climate change or others, but we're seeing much more of the balance between demand and then supply at the global stage for oil, the rewinding of cuts, production cuts in the Middle East by OPEC Plus, that's been having quite a bit of impact on supply side, keeping supply side quite nimble, I would say. And on the policy actions, well, I guess the message we heard was mostly, yes, we should, but there are constraints, and we'll see how it will all play out. Let me stop here.
Thank you. Meanwhile, we got a question in the chat. It's by Francesco Paolo. Is the restriction in the trade of rare earths, critical climate minerals, impairing trade and growth? How significant might a peace dividend eventually be with respect to Ukraine, Russia, and Israel, Hamas?
Again, very good questions. So on the rare earths related restrictions, those are not in our baseline, let's say. So we're watching the situation very carefully. And I mentioned in our risk scenario, we do have one of our layers includes supply chain disruptions. And you could think of those supply chain restrictions coming from this type of, export-related restrictions. But I'm putting a big but there because modeling these are very tricky. And even the production side, firms themselves find out where they're sourcing things as the supply chain starts getting clogged. So our exercises are very not granular enough, and this is something that we're working on. But it's just a big asterisk I would put. We do see some negative impact on growth if this type of restrictions lead to supply chain disruptions, but they can be very nonlinear. So we should definitely take our estimates there as a lower bound. On the peace dividend, I must say our baseline, our teams often assume, some resolution of conflict down the road. So to the extent that it happens in the next 5 years, they are kind of already put in our baseline. But it's a very good question. It would be a more case by case thing. I would think happening there at a global scale. The main channel, as usual, is the commodity prices. As we said, the commodity price volatility being low and commodity prices remaining low. That's the main channel we would see continuing to have a boost for the global economy. Thank you.
Thank you, Deniz, for these excellent answers to these very, very different, difficult questions. Let me now turn to Jason for the GFSR. Jason, you headlined the GFSR with a call for shifting ground beneath the calm. What sources of uncertainty do you see, and what are possible remedies to enhance resilience? Over to you.
Thank you, Ernst. Thanks so much again for SUERF for having us on today to have this conversation. Please bring up my slides. I apologize, there is a typo on the front page. I just noticed in the slides that I sent. Okay, next slide, please. All right, thank you, Ernst. So to quickly summarize the question that you asked, yes, our report is called Shifting Ground Beneath the Calm, and it reflects the fact that financial markets have been very buoyant despite the whole host of uncertainties, many of which Deniz just touched upon. So the way we look at things in the Global Financial Stability Report is we look at vulnerabilities, meaning are there channels for which adverse shocks to the economy can be amplified to cause financial instability. And so our overall assessment is that looking across the vulnerabilities this time, financial stability risks remain elevated. And today I'll touch upon 3 key vulnerabilities plus some other ones. One is stretch valuations. So risk asset prices are well above fundamentals. This leads to higher risk of abrupt asset price corrections in markets. There's also sovereign bond market issues, which Deniz has touched upon. Widening fiscal deficits has increased the fragility in market functioning in these bond markets. And in terms of non-bank financial intermediation, or NBFIs, open-ended funds, private credit, stable coins, they're becoming more important and has stronger nexus with banks, and yet they are still opaque. So this is a longer term issue, perhaps less imminent compared to, let's say, stretch valuations risks, but nonetheless is a key vulnerability in the financial system based on our judgment. Two other topics that I'll quickly touch upon is credit markets, which is, while not an imminent risk, we do see weaker firms struggling in this environment of still high global interest rates and tariffs. Defaults are ticking up in credit markets among companies. I'll touch upon that briefly. We have chapters 2 and 3 in the GFSR that are analytical chapters on special topics. This time, chapter 2 looks back at the FX market development over the past 10 years and look at the signs of resilience and risks. Chapter 3 looks at EM local bond markets, local currency bond markets, and asks basically the same question: how has things changed over the past decade, and whether that has made EMs more or less resilient. So with this backdrop, please move to the next slide. I thought that I sort of arrange my talk in these 5 topics because it's easier to digest. So I'll talk about asset valuations, the dollar and FX markets, which has been a focus of many heading into the annual meetings, sovereign bonds, emerging markets, and non-bank financial institutions. Next slide, please. So the macro backdrop, as Deniz has pointed out, was better than feared. If I extend this to look at some other metrics, inflation expectations have moved up but remains anchored. So if you look at the left chart here, that shows the inflation swap implied paths of inflation in both the euro area in green and the US in blue. As you can see, relative to the target of 2% for both the ECB and the Fed, inflation in the euro area is below that target currently. Inflation expectations 1, 2, 3 years ahead is below that target. Whereas in the US, inflation expectation is above, right? Close to 3%, 1 or 2 years out. And even in the longer run, it's not converging towards 2. It's rests at around 2.5. So the inflation picture remains pretty differentiated across these 2 regions. And yet, if you turn to the picture on the right, we have sticky inflation, but the Fed is easing at this moment. So this chart here shows the expected monetary policy rate across jurisdictions 6 months ahead. In other words, at any given date, we look 6 months ahead and see what the implied policy rate would be based on financial market instruments. And you can see that, earlier this year, there's a divergence between the Fed in the blue and other advanced economies in the red or emerging markets in the orange, right? So the divergence means the Fed is on hold, but other places are easing monetary policy. That divergence is gone, right? Now monetary policy is converging between the Fed and the rest of the world, despite sticky inflation. Next slide, please. So against this backdrop, right, this has contributed to one of the factors contributing to very buoyant asset valuations. So in this slide, we look at stock markets in particular. So the left chart here displays the 12-month forward PE ratio as a percentile historically, right? In the United States, in the red, right now the PE ratio is close to 96 percentile historically. So very, very stretched valuations. In advanced economy, excluding the US in blue, and in emerging markets, valuations have also rebounded very significantly from April. However, they are at much more reasonable levels at around 60 to 70 percentile, respectively. So part of this very buoyant stock market has been supported, as I mentioned before, by lower interest rate expectations, right? So if you look at the chart on the left here, on the right here, the interest rate component to these S&P 500 prices. So if I take the S&P 500 price return, I do a decomposition, basically 3 things: whether earnings have been surprising, whether interest rates have moved, and whether equity risk premium has moved. You can see that the interest rate portion, the orange here, has played a major role in pushing up S&P price returns since April in the right set of bars. So this means that the expectations for the Fed to cut, despite very sticky inflations, have really supported equity valuations. Now, earnings being better than they expect in the red portion here has also helped push up the price returns, but I wanted to highlight sort of like the interest rate channel here. Next slide, please. So the key theme here is valuations is very stretched. If we look at concentration, this is even a bigger concern in our view. So the left chart here shows the concentration in the S&P 500. What we calculate essentially, so the blue and the red lines are the PE ratios that we've shown before. The blue lines is the technology-specific PE ratio in the so-called Magnificent Seven and other technology stocks. But what I want to turn your attention to is the green line. The green line is the inverse of an HHI index of the S&P 500. Basically, the higher the green line, the lower the number of stocks that drives the overall market, right? So right now we're at around 40 companies that drive most of the variation in the stock market. And so this level of concentration is concerning. A lot of media is now discussing the so-called incestuous nature of some of these AI investments, right? So you have OpenAI investing in Microsoft investing in OpenAI. They both invest in NVIDIA, right, to buy chips, etc. I think this is another amalgamation of the concentration in the market that we are seeing here. If we look at some other markets like corporate bond markets, shown in right here, corporate bond spread in both high yield and investment grade, in both US, Europe, and UK are close to their historical tights. So it's not just the stock market, but also the corporate bond market are showing signs of very stretched valuations. Next slide, please. So against this backdrop of very stretched valuation and very optimistic markets, right? One of the things that we are concerned about is the gap between risks and actual financial market volatility. The chart here shows a measure of geopolitical risk by Caldara and Iacoviello, normalized historically into a Z-score, and compares it to a standardized index of financial market volatility, which is basically the average of the VIX, the currency VIX, and the high yield bond VIX, right? So you can see that the gap has really opened up between these two measures, meaning that the market volatility is really not catching up to the amount of geopolitical risks, out there globally. Next slide. This is the same picture with the same financial volatility measure. So by the way, when the financial volatility measure is below zero, this means that it is volatility in markets is lower than historical standards. But this time we compare it to the economic uncertainty measure, which is very similar to the one that Deniz has shown. The disconnect is even bigger between uncertainty and volatility compared to between geopolitical risk and volatility. So this is another sign that the market is very optimistic. And of course, the concern here is this abrupt closing of this gap, right? In particular, when volatility, right, were to spike up to the level of uncertainty, this is the type of situation that can upend financial markets and cause financial instability that we are concerned about. Next slide, please. Let me move on to the second topic, which is the dollar and FX markets. I think we are all very curious about the dollar movements in recent months since April of this year. So this is a very simple model. What we do is we take the broad dollar, the DXY index in Bloomberg, and just regress it on various things that purportedly drives the dollar. Interest differentials between the US and G3, trade balances, oil prices, dollar futures positioning, the VIX, and a measure of fiscal uncertainty, which I'm sure Davide will talk about. And so you can see that, in the shaded area of this chart, this starts in April 2025, and this is monthly data, right? You can see that there's steep dollar declines in the line in April, in June, and again in August. August is being the last month. So overall, there has been a period of pretty sizable dollar declines, which culminated to the dollar being 10% weaker so far this year. But in those months, if you look at the contributors to this depreciation, it is mostly two things. One is the fiscal uncertainty in the green here that has contributed a lot to the downward movement in the dollar, as well as the switching of dollar futures positioning in the market from positive to negative. That's the red here that has contributed to the depreciation of the dollar. So this positioning is basically how investors are betting on the momentum of the dollar, being whether it's going to go up or go down, right? So the dollar futures positioning has been turned from positive to negative, which has contributed to the depreciation. But notice also that the gray bars are pretty large. These are the residuals for the model, right? The R square of this model is around 20% or so. So it's not explaining a whole lot. There's huge residuals in the gray bars. And in particular, in the months since April, we see large residuals pointing downwards, meaning that it's leading to dollar depreciation. So one quest is to understand better where these residuals come from. Next slide, please. And I think in the GFSR, we have some answer to this, although not entirely. So we believe that some of these negative residuals in the dollar's movement comes from more incentives for non-US investors to hedge the dollar exposures. So in the left chart, so hedging data is very difficult to obtain. If you think about, let's say, a pension fund in Japan, right? They have a sizable US dollar assets portfolio. How do we know how much of that portfolio is currency hedged? It's very difficult to obtain. It is easier in some jurisdictions like the Netherlands, Denmark, etc., where we do see the actual hedging. But overall, a global picture of hedging dollar risks is a little bit difficult to obtain. So what we do in the GFSR is we try to address this question more theoretically. We ask ourselves, if from a non-US investor's perspective, they are investing in equities and treasuries, right? These are the two left panels, respectively. US equities and treasuries, respectively. And considering that their objective function is to minimize the asset return volatility of those portfolios, right? Given prevailing market conditions, what is the optimal hedging ratio for them to achieve that minimum asset return volatility? And the answer is essentially the green line here. The green lines in the left shows you that the optimal hedging ratios under this criteria has drifted up sequentially since the beginning of 2025, which tells us that the incentive to hedge US dollar portfolios has increased significantly. The gray area is the range across 11 different currencies. So depending on where the non-US investor is sitting, whether in Japan, whether it's in Euro area, etc. But overall, the green line shows the median of this range and has certainly drifted up. That is a sign to us that perhaps the incentive to hedge by non-US investors has pushed the dollar down. So what is the upshot here? Well, the right chart here tells us that many different countries have huge US dollar exposures, including the Cayman Islands. Of course, this is a financial center issue, but also Japan, Great Britain, Canada, Luxembourg, Hong Kong, Korea, Taiwan, etc. So trillions of US dollars held. And if we compare the US dollar assets scale by the FX volumes in those markets, this can give us an indication of how difficult it is to hedge the US dollar, right, exposures. So the higher this ratio between assets to FX volumes, the more difficult it is for them to hedge, because any hedge will move the market, right, significantly in FX markets. So as you can see that, the highest dots here belong to jurisdictions like Taiwan, Hong Kong, Norway, as well as Korea, right? Where you have relatively shallow FX markets, but huge dollar positions, meaning that hedging for these places might be a little bit more difficult. Next slide, please. So let me digress a little bit and talk about Chapter 2 a little bit. Chapter 2 does a very surgical look into how FX markets have evolved over the past 10 years. The left chart here should be familiar to everybody. This is based on BIS data, and this basically illustrates a picture where, in terms of FX market outstanding, whether it is in swaps and forwards or in derivatives, overall, the size of the FX derivative market has increased a lot. So that means that there is deepening in the FX markets over the past 10 years, which is good news for financial stability in general. That said, the impact of FX markets also spills over to other markets. So, the chapter documents various ways to look at this. One thing that I'm going to focus on today is, suppose there's a shock to the cross-currency basis, right, in a given currency. How does that spill over to the 5-year sovereign bond yield of that country? So imagine the yen-dollar basis were to spike up. How does that affect the sovereign bond yield in Japan, right? That's essentially the question. And you can see that the answer differentiates a little bit between whether the country has low debt to GDP, in other words, a fairly resilient country, versus a country that has high debt to GDP, a less resilient country. And so in high debt to GDP situation, a shock to the FX market cross-currency basis will have significant and persistent spillover to the 5-year sovereign bond yield. Now, I have to commend my colleagues. They did a very careful job when they do this. This is identified using a granular instrumental variable analysis, and interested colleagues here can read the chapter to get more details. But overall, the FX markets have evolved, have gotten deeper. However, they have also become more consequential for other financial markets. Next slide, please. So to round up my dollar discussion, with the dollar weakening, with more hedging desired, and perhaps with more diversification desired by global investors, meaning they don't just want to invest in the US dollar anymore, right? We have seen some of these other quote unquote safe assets appreciate significantly since April. This includes gold in the green line here. I'm not sure why gold is not in the gold line. That doesn't make sense to me now. But you know, it should be in the gold line, but gold has appreciated significantly, as have Swiss franc and some certain other assets. Now, this diversification and hedging of dollar risk issue is quite separate from the dollar status, right? I've noticed that when investors talk about these two issues, they often lump them together, as if people moving away from the dollar a little bit is going to threaten the dollar status. You know, my assessment says that the dollar status is unlikely to change. It is true, if you look at the table on the right, that the dollar has declined in terms of FX reserve shares. It has declined when it comes to trade invoicing shares. It has declined when it comes to FX and interest rate derivative turnover, right, from 69 to 63%. However, the assets held by foreign investors as a percent of the rest of the world GDP has never been stronger. It was 28% in 2014, but now 40% of the rest of the world GDP, or 39% of the rest of the world GDP, is held in US dollar assets. That's a very significant exposure to the US economy, right? And counsels the idea that, you know, it is very difficult to move away from a market as deep and liquid as the US. Next slide, please. So I better speed up. A key risk that we judge going forward is the sovereign bond market fragilities. This picture here is quite telling. It basically shows the amount of sovereign bonds that need to be absorbed by the private sector. In other words, share of outstanding sovereign bonds not held by central banks or public authorities. And we have made certain projections on how this evolves in the US, Euro area, and Japan, particularly in the Euro area and Japan, where QT is ongoing, right? In the US, QT might stop pretty soon. We are seeing that, you know, significant shares, like close to 80 and maybe close to 60% in Japan of of sovereign bonds will need to be absorbed by private investors. That puts a lot of burden on the financial markets to absorb these bonds and to intermediate these flows. Next slide, please. To fix ideas a little bit, market has told us that they are involved, they're concerned, right? So if we look at the left chart here, I will focus your attention to the green line here. This basically, for the G4 economy, we are showing the spread between the 30-year and the 10-year government bond yield. So the spread between the 30 and 10. And as you can see, there has been, you know, historically, there has never really been an abrupt rise in this spread compared to what we've seen since April of this year. The 30-10-year spread has just risen abruptly, you know, over the past few months, as a sign that investors are beginning to worry about, you know, the fiscal picture in G4. And so when we ask the question, okay, so what does it mean for yields, right, and term premiums? We run a very simple model on the right here. Basically, we plotted the relationship historically between government term premium at the 30-year maturity against the what we call free float. This is a percentage of bonds that need to be held by the private sector investors, as I showed in the previous picture. So you can see that the relationship is very striking. And if we were to project that relationship to 2026, we will actually end up with 30-year term premiums average across the G4 of close to 2.5%. We have not seen such high term premiums for a few decades now. So the evidence is pointing towards higher term premiums, higher longer term rates, essentially as a result of some of these fiscal concerns by investors. Next slide, please. So then the question is, well, so what, right? I mean, sovereign bond, you know, term premium might be higher. You know, how is this a financial stability concern? I think it is a low probability event that we're going to see some major disruptions in sovereign bond markets, but we can all understand in this group here that the severity would be very high if disruptions were to occur in sovereign bond markets. So this slide here basically tries to game out a stress scenario. And the stress scenario here is positing a situation that mutual funds are facing outflows and therefore they have to sell government bonds. So the question is then what happens, right? So the left chart here shows the portions of US domicile bond mutual funds that hold treasury securities. So it's very US focused. If you look at the red portion here, it blows out and shows us that about 25%, right, of the safe assets held by US mutual bond funds are held in treasuries, the red portion here. They also hold some treasury bills, the green part, and some money market fund shares, but those are small compared to US treasury bonds. So then the question is, okay, what's going to happen when these mutual funds were to face a run? What we think will happen is they will do what we call sell what you can sell situation, right? So these treasuries are held for liquidity purposes, so that when redemptions come to mutual funds, they will use these treasuries to liquidate these treasuries to meet the redemptions. So the right chart here basically illustrates what might happen when this happens. So if we look at the middle set of bars, for example, these are using fund level actual mutual fund outflows in March 2020, plus a 80% basis point rate shock because there is a adverse feedback loop between fragilities in bond markets and higher yields, right? So we assume that there's a rate shock as well. And you can see that in that scenario, essentially mutual funds will be forced to liquidate close to $200 billion of treasuries, money market fund shares, and cash, right? So this is how they're going to meet their redemption. If we take the 99th percentile of outflows historically at the fund level, and then we assume 100 basis point rate shock, that's the right bar, that liquidation can go up to $350 billion. And that's going to be a sizable impact to the sovereign bond market. Suddenly, there are tons of bonds that need to be absorbed, right, in the market, and that the adverse feedback loop between more selling and then more higher rates, more selling and more higher rates might ensue. So this is one way that we think about sort of like gaming out a scenario of how sovereign bond market fragility can look like. Next slide, please. So with the sovereign bond market, being one of the key vulnerabilities, it's also natural to ask what happens to emerging markets. These are particularly sensitive to global financial conditions, including bond yields in advanced economies. So in Chapter 3 of the Global Financial Stability Report, we take a longer term look and we ask the question, what has happened to these EM assets over the past 10 years from a global investor's perspective? The left chart here is a chart of Sharpe ratios in various asset classes versus the tail returns, meaning what is the 5th percentile of tail returns? In other words, very extreme negative returns compared to Sharpe ratio. And you can see that most assets behave as you would imagine. If you have a high Sharpe ratio, like US equities, then the tail is also longer, right? You have the worse 5th percentile. Conversely, treasury bonds on the left dot here in the left chart is one where the Sharpe ratio is low, so it's a very safe asset, but it doesn't return very much. And at the same time, the tail returns is not very high, right? As you can see, on the vertical axis here. When it comes to EM assets, so I'll turn your attention first to the red dot here, the EM local currency total return. It's really neither, right? Has neither of these properties. It does not have a high Sharpe ratio. It's not very attractive from a returns perspective, but you might also lose a lot of money, right? So over the past 10 years, EM has not been a great asset class to invest in compared to some of these other asset classes. And the right chart here illustrates why. It basically decomposes the local currency bond returns into 3 components. The FX component, meaning the currency of the emerging markets, the price returns, and what you can clip in coupons from those bonds. And what you can see is that basically the dark green area, the weak EM currencies have really dragged the performance of EM local currency bonds over the past 10 years. So the FX risk in EM markets has been a headwind to EM asset class. Next slide, please. But news is not all bad. As a result of EM assets not being very attractive, many EMs are no longer relying on large amounts of external financing, and rather they are relying on their own resources to fund their governments, fund their fiscal spending, etc. So the left chart here shows basically the percent of GDP non-resident holdings of local currency government bonds in EMs. And you can see that countries like Mexico in the middle Hungary, Poland, Indonesia, India, Thailand, etc., have really now have low reliance on external financing, on non-residents, in order to fund themselves, right? The range has been quite large historically, but now many of these countries are at the bottom end of the range, meaning that they are, not even 10% reliant on external financing. I think in the EM market, the big question is always, what about China? China is so consequential to EM markets. It is really the big unknown, right? I think Deniz has touched upon a number of these issues. GDP growth has slowed. Inflation rate has moved into deflation territory. The property market remains very much in the slumps. But there are also some good news. The stock market has rallied. And part of it, we like to look at alternative data. It's driven by this AI optimism in China as well. So if you look at the share of global AI research publication, it's gone from 21% in 2019 to close to 36% now. So part of what's buoying the stock markets is also the optimism about future Chinese technology. So it's really a mixed bag in EMs, and I'm welcome questions and comments on how we covered this here. Next slide, please. Okay, maybe we can skip this one, following slide. So turning finally to the final topic, non-bank financial institutions. Let me start with banks, actually. So this slide is about banks. In aggregate, global banks remain resilient. What we do is a global stress test in the Global Financial Stability Report. We examined 669 banks from 29 countries, and we basically shocked them with an adverse macroeconomic scenario. So higher employment, lower growth, higher inflation, higher interest rates, etc. For those interested audience, you can read the gory details of the scenario in online annex of the GFSR. But the left chart here shows what happens to bank capital ratios, particularly the Common Equity Tier 1, CET1 ratio, by region under the stress scenario. So I'll turn your attention to the red line here, right, which shows that globally, once the shock hits, in 2025, CET1 ratio is going to decline significantly by about 3 percentage points, but then it's going to flatten out in 2026 and 2027. But this picture is not the same everywhere. So in advanced economies, the initial shock is quite impactful, right? But as you can see in 26 and 27, it recovers a little bit. In emerging markets, the third column here, you can see that it's the other way around, right? The adverse scenarios impact accumulates over time. And a lot of this is driven by Chinese banks, and because they are thinly capitalized and they are most likely to be at risk. So the aggregate picture tells us that capital ratios will be okay. Anything above 10 is, pretty okay. And as you can see here, in the adverse scenario, even global banks will have more than 10%, right, in CET1 capital ratios. However, the right chart shows that there's always a distribution, right? Some banks are going to be weaker than others. So there is a weak tail of banks under this adverse stress scenario. What we show here is basically by buckets, the post-stress capital ratio across different banks. As you can see, among the globally systemically important banks, or GSIBs, the worst bucket has capital ratio between 4.5 and 7, right? Amber, kind of orange, alarming, but not devastatingly poor. But if you move to the smaller banks, the non-GSIBs in the middle, you can see now that there are some banks with less than 4.5% CET1 capital ratio, which is quite concerning. And if you look at non-GSIBs in emerging markets, the right set of bars, we actually have quite a number of banks, that have like below 7, below 9 in CET1 ratios in these adverse scenarios, which again is telling us that in aggregate, the banking sector seems to be fine, but there are these weak banks that are concerning. Next slide, please. So even though banks are going to be fine, but one area that we focus on in the GFSR is the nexus with the NBFIs, the non-banks. And bear with me, this chart, Ernst, here. I'm going to try to explain this chart. So what this chart shows is, along one dimension, the NBFI exposure to Tier 1 capital, okay? NBFI exposure to Tier 1 capital. So you can see along the curve, the red areas are banks that have NBFI exposures, more than 100% of the Tier 1 capital ratios. In other words, the thought experiment will be, for these banks, if the NBFI exposure is all gone sour, then it will completely wipe out the capital, right? That's what the red color means. And so along the other dimension is the log of total assets of these banks. And so the key takeaway I want you to leave with is that whether it is in the United States banks on the left chart or the Euro area banks, the banks that have large NBFI exposures in the red region are also banks that are larger. They are the ones that with higher total assets. So larger banks tend to have larger exposures to NBFIs. And that is a correlation that's concerning in my view. We have a situation where the largest banks are quite vulnerable to a shock in the non-bank system. All right. Next slide, please. So one of the areas where non-banks have been particularly active in is to provide loans, or the so-called private credit market, right? The left chart here basically shows that, outside of private credit, if we just look at, corporates in general, default rates are rising, particularly among the syndicated loans. These are lower grade borrowers that borrow from a consortium of banks in the US. And you can see that the default rates have risen to close to the pandemic level, right, around 5%. On the other hand, the high yield bond borrowers are fine, because high yield bonds, the weakest borrowers in the high yield bond market has over the past few years migrated towards these loans markets. So the weaker, it's a composition effect. The weaker borrowers are now borrowing in the red market, right? And therefore the green market looks a little bit better, right? But defaults are happening, and the credit market is not all fine, right? And that's something that we point out in the GFSR. And if we look specifically in the so-called private credit market, these are basically non-banks, like your private equity firms that lend directly to weaker borrowers. You can see that the amount of downgrades in the red bars on the right here has increased significantly in recent times compared to the amount that has been upgraded, which is in the green. So credit markets are deteriorating. Next slide, please. And so one final topic, I'm sure many audience will be interested. I also think that one type of non-bank is stablecoins, because they're intermediating between savings and other asset markets. So in the GFSR, we cover stablecoins a little bit. First, we show that it has grown a lot. Everybody is aware of that. What's interesting is that, a colleague of mine, Marco Reuter, and at the fund has basically done a flow analysis of how stablecoins flows globally, and that's the left chart here. You can see that most of the outflows, right, around 54 billion as of 2024, has come from the North America, right? North American outflows has gone into Asia, has gone into Europe, has gone into Africa and Latin America. But there are also some interesting other patterns. So for Asia Pacific, for example, they received 20 billion of inflows, but outflows also constitute about 8 billion going towards Europe and going towards Latin America and the Caribbean. That's the green, that's the blue arrows here, right? In Europe, Europeans have mostly been recipients of stablecoin flows. This is a very interesting finding, and I think I'm curious to hear if the audience have any views about this. But I think the stablecoin flows have become more important, but more importantly, they're intermediating more, right? If you look at the chart on the right, stablecoins constitutes one of the largest, quickest growing treasury bill buyers, because once they get the stablecoin inflows, they will have to deploy it into the assets like treasury bills, like repos, etc. And you can see that the stablecoin column, the second to last column here, has the very high diamond, right? This is the growth rate, basically telling us that they are buying 80% more treasury bills in 2025 compared to the previous year, right? It's a fast-growing and very significant segment. Next slide, please. So let me conclude. These were the 5 topics that I set up at the beginning. Next slide. The punchline here is that asset valuations are stretched. Dollar and FX markets are stable so far. Sovereign bonds are more fragile. Emerging markets are resilient, but only so far. Non-bank financial institutions more complex and impactful on financial stability. My final slide, please. So remember the vulnerabilities that I set out at the beginning. We are concerned about stretched valuations, sovereign bond markets, and NBFIs. What do we do about this? As Deniz had done in her session. So in terms of policy recommendations, stretched valuations is the most difficult thing. There's few policies that can actually deal with it directly. Some people say macro-proof, but it doesn't really work when it comes to the stock market. But what we do think is that monetary policy should stay attentive to inflation. When inflation is sticky, they should really be cautious in whether to ease monetary policy or not, because we show that obviously monetary policy has pushed up asset valuations, right? When it comes to sovereign bond markets and fiscal concerns, Davide will detail this a lot more. We need urgent fiscal adjustments to curb government deficits and improve bond market structure like central clearing. On MDFIs, we need to improve data collection, especially understanding cross-border MDFI activities, meaning how for example, how a private credit fund in the US can impact borrowers in the euro area, let's say. There are FSB and IOSCO things that we can implement, but importantly, we should also ensure that the core of the financial system, meaning the banks, remain safe and sound, and implementing Basel III would ensure this banking sector resilience. Let me stop there, Ernst, sorry, I went over a little bit, but happy to answer question. Feel free to kick it to the end if that helps with the timing. Thanks.
Jason, for this extremely interesting set of slides and for guiding us through them. We have, let's say, 5 minutes for questions. Let me again start with some questions myself. Now, you list a quite worrying list of potential sources and triggers for financial stress or even crises. You also mentioned the possibility of spillovers between various parts of the financial system. You showed a couple of slides of stress testing. My question is, have you at the IMF embarked on a very comprehensive scenario and stress test exercise simulation exercise, where you combine various turbulences in various sectors and including spillovers? The second question is, it refers a little bit to what you showed at the end. So are policymakers now in a good place to cope with more severe stress scenarios, given their experience after the GFC and so on? You know, if you look at the media and at financial market indicators and also your charts, financial markets still seem to be in a sort of worried party mode. Let's put it like this. Should monetary and macroprudential policymakers take steps to calm the party down to some extent? Should monetary policy lean against the wind? I mean, you advised a little less. You said when inflation is, too high, they should not soften. So should monetary policy maybe even lean against the wind? And many observers now talk of multiple bubbles. I think this coincides with what you said in more factual language. And you call for policy action. How does this fit with the drive for regulatory simplification, or what others might say deregulation? And if I look at a question from the chat now, from Claudio Borio, there is no reference to real estate markets. Typically, this is much more important for financial instability than equity markets. All indicators seem to be green there, especially in major jurisdictions, leaving aside obvious cases such as South Korea, for instance, and Canada. So what's your take on these 4 questions?
Thank you so much, and so let me maybe address Claudio's question first. I think Claudio's thinking about China and South Korea. We actually have a box assessing real estate markets in the GFSR. It wasn't included in my slides because, as you rightly point out, it is outside of the case of China. It does not seem to constitute a major financial stability risk at present because household leverage is fairly contained. We think some of these other issues that I mentioned are more urgent. However, I think that picture might be changing. If the economy were to slow, if the projections that Deniz has described were to play out, household sector might once again become a focal point here. And we have already seen some cracks starting to occur, for example, in the US subprime consumer market, right? So a very good homework for us to bring home and address in the next one. In terms of commercial real estate, it remains a problem. But what we have seen and positively surprised by is the industry's ability to actually turn these physical assets from something that's more obsolete like offices to like apartments, right? And that has really helped, fend off like the costly defaults in the commercial real estate that we once feared and have covered, quite extensively in the GFSR. On the question on stable coins from Kasinja, I don't think, I don't think we are having the view that stable coins are very stable here at the fund. We're still trying to understand that, the industry a lot more. We've noticed a very, very quick growth and the fact that most of these are private in nature. And as you saw, with significant cross-border implications. So more needs to be done for us to make a full assessment. But I don't think certainly at this stage we're saying that stablecoins are extremely stable or making this kind of claim. And then finally, very quickly, Ernst, to your two excellent questions, the systemic stress test, very needed, very difficult to do. In the GFSR, we try to understand the spillovers in two main areas this time, from NBFIs to banks. That's one type of spillover. And then from NBFIs to sovereign bond markets. All right, we did kind of partial equilibrium analysis on both, and understand sort of like basically illustrated that NBFIs are becoming much more important, both to banks and both to sovereign bond markets. However, ideally, we will have a more holistic, systemic study. We are working on this. It feels like that it's easy to say we're working on this, but we are truly working on this to try to get a better view on this. And then finally, I think the other important question that you ask is that, is the buoyancy in the market a reflection that people have gotten more confident in policymakers to lean against the wind or to combat financial instability? I think the answer must be partially yes, right? Because now there is a view that there is, in addition to the monetary policy put, right, the so-called Greenspan put, there's also a financial stability put, meaning that if some financial instability were to happen, central banks will step in with their myriad of tools that they have gained since the GFC, but also during COVID, right? So I think there is some truth to, that the backing from authorities are stronger. However, if we think about one risk that Deniz mentioned, central bank independence, we cannot take independence for granted. How would an unindependent or less independent central bank react during financial crisis? Whether their credibility will remain strong to calm markets down? Those are all questions that, people like us studying financial stability are worrying about. And of course, we don't want to see, even if central banks have perfect ability to mitigate crisis, we don't want to see a crisis to happen to begin with, right? And so these vulnerabilities remains top of mind and something that need to be addressed. The trickiest one, as you have mentioned, is markets are buoyant. We cannot really, it's difficult to take the punchbowl away. The only thing that we can say is that be more judicious when it comes to monetary policy. But, happy to hear other thoughts as well. Thank you.
Thank you so much, Jason, for answering these difficult questions. Let me now turn to Davide. Davide, you're in charge of the IMF's Fiscal Monitor. Its overarching theme this time is spending smart, how efficient and well allocated public spending can boost economic growth. What does the current environment imply for fiscal policy and sovereign debt sustainability? How can ballooning debt dynamics be contained in this demanding economic environment? Over to you.
Thanks very much. Great to see you again, to be with you again. Let me give you an update of the Fiscal Monitor, and I will focus on two parts. The first is more about our view on projections regarding future debt and key fiscal variable, as well as the highlights of an analytical chapter that really dig deeper on one pressing issue that can help address some of these challenges that we see. Okay, this is basically something that is worrying us from the fiscal side. One on the left, this is a chart that also has been echoed in Deniz and Jesús' presentation. We've seen that uncertainty is very high. I was going to show this high level of uncertainty not only is bad for growth, but is also bad for many fiscal positions. It is affecting not only, let's say, the level of debt, the level of future debt, but also uncertainty regarding the debt outlook and what we call in our projection debt risk. Another issue of concern is elevated interest rate in many countries. We've seen that spreads have been more and more compressed, at least for some emerging market with relatively stronger fundamentals. But something that we see, and this is something that we project to be important going forward, is that interest rates are going to be high because of very high interest rate in some key economies with sort of free rates. We've seen both 10 years and 30 years going up. Take countries like Germany and the US, and this is unlikely to spill over to many other countries. Now, these are like two key assumptions that, in addition to the various assumptions that Deniz has discussed in the context of the WEO, that are shaping our outlook. If you look at the debt projection, we see that at the global level, now debt is projected to keep rising and to surpass 100% of GDP by 2029. When we were in April, we were projecting also a very high level of debt. We were projecting that the debt to GDP at the global level was reaching 100%, but by 2030. So we are sort of anticipating by 1 year this idea of sort of magical thresholds. And there have not been few years, if you go back to history, where we have seen this very high debt level at the global level. Only a few times around Second World War that we've seen very high large debt has declined, but we have not seen again this very high large rise in debt. Of course, there is as this chart shows, there is heterogeneity at the global level. US and China are really driving the global average, but also some important systemic economies that are typically large. Think about France or even Italy with a relatively high level of public debt that are contributing to this evolution. And if you think about emerging market countries, things they are not much more rosy in the sense that, yes, in some countries, debt is projected to stabilize or to decline. But still, if you compare to public debt that we have seen before the pandemic, in many countries, that level are projected to stay higher. So this is one important factor that is driving our fiscal assessment. What is driving this really sort of negative going forward assessment is what is happening with the interest payment. Here, what you see is our revision to projection, basically since COVID, and you see typical evolution of the primary balance, interest payment debt. You see that overall, we have not changed much. Nothing has changed much in the context of the primary balance. Of course, there's been a revision. I think now we have a less contractionary stance, for example, that we were projecting last year. But overall, there has not been much change. One area where things actually have moved a lot is interest payment to GDP. They were very low, they were projected very low, and to stay on a declining trend because the pattern of very low, and in some cases a negative real interest rate in some countries. Basically, what you've seen is interest payment at the global level were projected to decline. But since basically 2021, we have been constantly revised up interest payment because, again, interest rate have been higher, but also debt has been higher than expected. And this basically actually has materialized as what has been really driving upward our debt projection. If any, our debt projection benefit from the boosted inflation that we've seen in 2021. In many countries, inflation surprises has contributed to a steep fall in debt, but now we are back to to the previous trend that we had. That it was temporarily interrupted by inflation, and now in a situation where inflation is going back to target in many countries, we see that public debt is keep rising. What is driving our projection now? If you look not in terms of variable, but in terms of main countries, and this is on the left. What you see is the driver of change in projection from April, from when we met all together to present our flagship versus October. The size of the bubbles will give you the countries, and it's clearly that if you look at these two pictures, if you think in terms of countries, that is really driving upward our revision for fiscal position for both primary balance, overall balance, as well as debt ratio is really the US. We are now projecting going forward a weaker fiscal position for the US in terms of overall balance as well as a primary balance. And if you see the level of debt, the debt going forward up to 2030 for the US has been revised up considerably. Okay. For advanced economies, some other countries are moving the opposite situation. Japan, for example, is a cases where actually debt projection have been declined quite markedly, and there also a part of the story is the inflation pattern that I showed you in the previous slides. If you look at the emerging market and low-income country, there are no major changes in countries where there are few changes. Most of the changes are actually driven by change in GDP growth projections that are those that Deniz has just discussed. So let me now zoom a bit on some of this block of countries. Advanced economies is starting focusing on the US, then emerging market and low-income countries. Of course, the main change has been from the US. This is what we just said, and there's been the pass of the one big beautiful bill act. The act, what it basically does, it extended the provision in terms of cuts that we've seen in 2017. It included additional measures that basically more than offset some of the fiscal saving that are projected over the medium term. So despite what we've seen is a rising revenue from import tariff, we see that the deficit is projected to stay high, and the public debt now is projected to achieve 140% of GDP by 2030. And this is compared to 100, I think 25, 28 that we had in April. So we're talking about a revision of 12 percentage point to GDP for the next 5 years. Another group of countries from where we see significant strains in public finance, at least for some group of countries, is Europe. Europe, on the one hand, we've seen some countries where fiscal position have deteriorated. Now we see debt to go up, like for example in countries like France, or countries with still very high level of debt, Italy on the left-hand side. So huge divergences across countries. The main challenge for Europe are going forward very high, important rising spending pressures in a context of relatively weak growth. On the middle chart, you see the projected spending in terms of GDP on key area that many countries are expected to spend more. Think about climate, think about health, pensions, as well as defense. As well, we see like on the right charts, the target that many countries are implicitly aiming to achieve as a part of the various NATO reforms. So in the context of Europe, significant divergence in terms of fiscal position, are relatively weak growth and significant spending pressures on many factors, including defense. Emerging markets are a large basket, and with respect to divergence is quite big. At the global level, in terms of the group, what is really driving the contribution of emerging market to the global level is really China, given its size, but also given is a very steep increase in the projected public debt. In many emerging markets, there is a significant heterogeneity in terms of performance, both across regions. So if you look, for example, in Asia, you see that the debt is projected to rise more, also partly reflecting some of the largest effect of tariffs on GDP in some of these countries. Countries like EM, Latin America, we see that the debt is projected, for example, to stabilize. One important challenge that we see overall in emerging market low-income countries is also, again, interest payment. On the one hand, you see that in some countries, interest payment to revenue ratio is quite substantial, and this basically this give you an idea of how able are countries to basically finance interest payment on debt that are overdue. And you see that they've been rising, and they are quite sizable in some group of countries, for example, EM, Latin America, but also many of the emerging markets face the challenge of rolling over debt. For many countries, in 2025, there are expected to be significant rollover and on maturity for debt, and this will be an important challenge for some of them. Low-income countries, not much revision. Also, in the case of low-income countries, there is a typically significant divergence, often across region. A notable reason is often Sub-Saharan Africa versus the others. But one common challenge for low-income countries is, in addition to rise interest payment over revenue, is grants. What we see is grants for foreign aid has declined across all the boards. In some countries, even about 25–30%. And this reduction in grants is actually projected to not end in 2024–2025, but actually to continue over the medium term. And for some of these low-income countries, this is quite important. Typically, what we've seen is that some of the grants that these low-income countries receive are used for channeling spending in key areas for development, including health and education. So this will be a significant challenge for low-income countries. This is what we are projecting on the outlook. We want to emphasize that there are significant risks to the outlook that are typically tilted on the upside, in the sense that there are more significant risks that could be turned out much higher than what we are currently projecting. And this is actually on the right chart. We typically see that partly because sometimes growth turns out to be less than expected, and part because government do not follow on their plan. We typically see that forecast, so the difference between that projection and that materialization tend to be quite biased, and the bias goes in a way that realized debt is typically larger than projected debt. And this difference is quite notable. It's about 10 percentage points of GDP for many countries. And importantly, these numbers tends to increase when authorities or countries are projecting debt to decline. And that really emphasizes the fact that it's very hard for policymakers to follow up in reduction of public debt and in progress that aims, for example, to contain spending or raising taxes. What we show the left charts is our data risk that we presented also in this webinar a couple of years ago. What we show is that in a severe but plausible scenario, indeed the public debt at the global level could be almost 20 percentage points higher than what we are currently projecting if you think about 2–3 years ahead. And this number actually will increase if you extend the horizon up to 5 years. What is driving this data risk are uncertainty regarding the economic outlook, including uncertainty, but also potential tightening conditions in financial stress. So what we do in this very constrained environment where we have a situation of high public debt, which is actually projected to rise, with growth and significant spending pressures. As some of the message that already have been conveyed by Deniz and Jason, the path forward is a significant, in some countries, fiscal adjustment that is within consistent medium-term fiscal framework. Of course, the pace of the adjustment as well as the magnitude has to be country-specific, depending on where countries are in the economic cycles, whether it's their initial debt position and additional factors that affect the dynamics. But for many countries, primary adjustment are needed in the terms of fiscal balance. So how to do that? And there are different policy options for many countries. For some advanced economies, there is significant scope to rationalize some spending. Think about pension to identify additional resources, reduce tax exemptions in emerging market policies to increase tax bases, as well as to reform subsidies. But one key element that applies to both advanced emerging low-income countries, and it's something that I'm going to focus the rest of my presentation, is on what we call spending smarter. And here for spending smarter, we think about two components on how countries can spend smarter. Countries can spend smarter by improving allocative efficiency, in the sense by improving the composition of their spending, to focus on spending that has the premises to generate higher growth dividends. And the second arrow, through which means spending smarter, is improving technical efficiency. So improving the amount of money that policymaker can get when they spend. So the maximum level of output that they can generate by spending on a given category of spending. And this is really like the question that this analytical chapter that we presented is trying to address. The first is like whether there are really scope for countries to improve spending composition and efficiency. The second is if there is scope, what countries can do in terms of policy change, in terms of reform that can improve the efficiency in the way that they spend, but also the allocative efficiency in the categories that they spend. And finally, what we ask in this chapter is, assuming that countries are successful in doing reform that help them to spend smarter, how large they can be the output gains and output dividends. And let me touch upon quickly to answer these three questions. The answer to the first question is that if we look at both the composition of spending as well as the efficiency, there is a significant scope for reforms. For many countries, just to give you a number, on average, a typical economy has an efficiency gap of 30%. In other words, by improving efficiency, the average economy in the world can get 30% more money or value for what they input in production. So this is a big number. Second is that there are many cases where actually this reform are taking place through different means and different policies. In many countries, one important policy is a stronger institutional framework, including on the fiscal side, including the improvement public investment management process. And finally is that yes, there is scope. Second, yes, countries can do it. And third, there are big gains if the countries follow up. For both advanced and emerging market economies, measure spending reform that involve both improving the composition as well improving the efficiency can deliver significant output gain for about 4% in advanced economies and even to 11% for emerging market low-income countries over the longer term. So let me highlight some of these 3 points quickly. The first is that looking at the composition of spending, what we see is in many countries, spending has increased over time, but in some countries, on average, is more than 40% of GDP, like advanced economies, but has not necessarily been allocated to more pro-growth area. For example, if you look at public investment, what you see is that public investment has been on a declining trend across all the board for both advanced, emerging, low-income countries. This is on the second chart. And on the right chart, if you look at categories that you may think that are more associated to growth, think about education, think about R&D or health, these 3 components together, they account for only 1/3 of total spending. More about, in some countries more, some countries less, but basically this is the number, so to 1/3 of spending on pro-growth is allocated. What goes to the rest, a big component goes to social protection, social protection and general public services. The second element about spending is that in many countries, this spending is locked down from one year to another, in the sense that spending is relatively rigid. We put together a novel database about spending rigidity across all countries, going back in time. What we see is that spending rigidity is not always necessarily bad, in the sense that sometimes it can be actually good if, for example, It comes from a medium-term fiscal framework that they anchor public investment to be executed, let's say, over the course of a few years. But in some cases, it actually comes from inefficiency or mandated spending. We see a large component of mandated spending in many countries is public wage bill. Again, public wage bill doesn't mean that monies are wasted or not well allocated, but to the extent that the public wages are driven by a significant premium compared to the private sectors, this is our signs of inefficiency in the market. And what we see in the data is that typically countries that have very high spending rigidity, they have more difficulty in reallocate public spending, especially during periods when are needed, like periods of recession or periods of economic vulnerability. What about efficiency? There is a significant scope of improved efficiency across all countries and across many areas. However, there are two sources of heterogeneity. One, as you would expect, spending efficiency, advanced economies are typically spend more efficient than emerging market low-income countries, even though there is a huge variability within each group. So there are indeed some emerging markets for which spending efficiency is higher than advanced economies, and the same also happens for some low-income countries. Another area where there is a significant heterogeneity is about the item. There is much more waste or less spending efficiency in the area of public investment or research development than in the area of health and education. When we put this data set, one innovation of this data set is that not only covers almost all countries in the world, but also is time varying, so it will really help us to track how this efficiency in spending has changed over time. And this is what we show in this slide. You see that, and this is actually very positive, many countries have made significant improvement in their spending efficiency. We see that spending efficiency have sort of converged, reflecting technology, reflecting outcome and improvement, including life expectancy and so on, but there are still a sizable gap right now. So what countries can do? What we typically find in the report is that strengthening governance and administrations leads to more efficient spending. Countries can also improve processes, including through spending review. And what we find in the data is that the spending review are typically associated with the spending more allocated to pro-growth. Here, for example, we show that following a measured spending review, spending on wages, like for example, versus spending on pro-growth item, think about investment, think about education, think about health, tends to decline. And second, what we find is that the spending efficiency tends to increase as a result of this spending review. And finally, let me jump to the last part. What are the potential gains from spending smartness? In the chapter, we do both empirical analysis as well as a model analysis, but let me focus on the second and narrow down mostly on the very long-term effect. What we find is that by reallocating, if countries would reallocate public spending, so keeping the total envelope of public spending fixed, so you reallocate spending, let's say, from government consumption to either infrastructure investment, to human capital, or R&D, what you see is that over the longer term, the countries can generate significant output gain. On the left, we see the results for advanced economies. So our analysis suggests that a measured reallocation, so a relocation of 1% of GDP from government consumption to, let's say, infrastructure investment is expected to increase output in advanced economies by about 1.5%. And this effect is even larger if you think about a relocation towards human capital and R&D. These gains are typically larger in emerging market development countries, and the reason is because of these countries, they typically start from a lower level of capital in the production functions. So what happens is when you reallocate the same amount, 1% of GDP, to either infrastructure investment or human capital in emerging market, these gains are almost double. Over 2050, so we're talking about 20 years from now, a significant reallocation of spending can lead to about 3% of GDP if it's done on infrastructure, or about 5.5% when done in human capital. Importantly, these gains that you see from reallocating of spendings, they are really and importantly shaped by improving technical efficiency. So if countries they were to close the gap that I showed you in the previous charts between their performance and the performance of the best frontiers, these output gains are significantly magnified. What you see in advanced economies, the additional output gain that advanced economies could achieve by closing efficiency gap are almost about 1.2% for infrastructure investment, 1% for R&D, and 0.1% from human capital. In emerging markets, these additional gain from improvements in efficiency are even larger because on average, these countries have larger efficiency gap. And that is important to highlight two sub-results. The first is that these gains are larger, the larger you are from the frontiers. Of course, the more scope you have to close the gap. And the second, it also, the effects are larger, the faster you tend to close this gap. So it shows that important reform, like for example, those that have implemented in few countries that we show in the report, like Togo, Rwanda, etc., that help countries to successfully improve efficiency over relatively short times can really lead to significant and additional output gains in many of these countries. And finally, what we show in the chapter is that there are important complementarity in the way policies are done. Not only countries can decide to relocate to one component versus another, but when the two components have really complementary scope, there is a significant output gains. And what we show in the chapter is, like, for example, if you are an advanced economist, is actually because there is a large complementarity in human capital with R&D. If you actually reallocate, let's say, 0.5% of GDP to human capital and 0.5% to GDP in R&D, the output gains are larger than if you do a simple reallocation to one category, considering isolation. And second, there is significant scope in many countries to improve service delivery. And we show that in the case, for example, emerging market, there is a significant point in improving service delivery is with the digitalization. In advanced economies, we show like that, for example, this via technology diffusion by considering the private sector and so on. So let me wrap it up with the key policy message. What countries can do to spending smarter, given that there is significant scope and the output gains are large. We identify three main areas where countries can act. The first is improving, I'll go back. Okay. The first is improving process and management and institutions. And then we identify two main areas. One is strengthen institutions, strengthen governance, strengthen spending efficiency in terms of effectiveness in the ways government spend. And second, upgrade public investment management. The IMF does a lot of training on this in terms with the PIMA that has developed. In many countries, there is scope to rationalize spending. This can be done through spending review that align spending of the objective of the government with actual spending, but also tends to remove inefficiency in the way spending input are, for example, done. Another area where it's very important, is especially for advanced economies, is improving competition and transparency of public procurement. In many advanced economies, a large component of public infrastructure spending, for example, is channeled by public procurement, so improving transparency there is important. There is scope to rationalize some spending. In other area, think about pension, things about, for advanced economies, things about energy subsidy for emerging markets is something that we talk about in the previous chapter. And then service delivery, digitalization in public finance, and involvement of the private sectors. So I stop here. So I hope that we can have a few minutes for some of the few questions that I just see that are coming. Thank you.
Thank you, Davide, for this excellent and very policy relevant presentation. Meanwhile, we have a couple of questions in the chat, and I have some myself. First question here is, what is the possible impact of higher defense spending on growth? I'm sure the IMF has thought about this. Another question is, you mentioned the impressive potential efficiency gains that governments might achieve through the areas that you just mentioned. How do you as IMF transfer these important insights into your Article 4 consultations? what are the main obstacles to such obvious policy measures? I mean, who might not want to become more efficient with the same output? Then second, another question is, what do you exactly mean with improving fiscal institutions? I think I didn't hear your view on fiscal councils. What role can these play? And what about switching to zero-based budgeting, as I think very few countries do at the moment? And the final question: if all this doesn't work out as you propose, now, given rising debt dynamics, big structural rises in spending for aging health defense, I have 3 percentage points in my memory from your chart for Europe. Which scenarios do you see for the interaction between fiscal and monetary policies? Are we potentially heading towards fiscal dominance and financial repression? I hope this doesn't overwhelm you, but yeah, I'd be interested in hearing your views.
Okay, no, thanks very much. On defense spending, you've been asked quite a few times across all the various presentations that we have done. We have done some work which are going to release in the coming months, where we will analyze estimates of defense spending, especially in Europe, whether there are spillover, how large these are, factors that can shape the defense spending. So stay tuned for the exact numbers. My sense is that if it is something that you want to take out from our analysis from this chapter that is relevant for defense, is that there are many components of defense spending, and really it's likely that the effect will really depends on what you spend on. So if you spend something that is related to investment, that is related to enhancing R&D for the economies, these effects are likely to be larger and more long-lasting. Whether is the defense spending, let's say, for services or for, let's say, bullet. So there is I think, significant heterogeneity, and some of this heterogeneity, I think, is captured by some of the results that are presented, that I just presented. But again, I think stay tuned, because we're going to release a few papers that will deal with this issue. On how the IMF incorporates this in the context of Article 4, I think for many years we didn't have an update of estimate of public efficiency. This database that is already used by other colleagues in the department, across the very area department, we receive huge interest in featuring actually in Article 4 report, and see countries, the progress they've made, what are still the gaps. So it's something that is coming up. And there's also, there will be soon a working paper that will be released, where various measures of spending efficiency, as well as the codes to generate spending efficiency, will be made public available for all researchers. So it's an area where the IMF does a lot of work, in terms of advising countries, but a lot of work in terms of capacity development and technical assistance. And it really seems that improving like some of the element for which we do actually technical assistance, like public investment management assessment, what we call PIMA, typically are associated with improving efficiency. So in some sense, this was also positive for us, because it's a sense that the technical assistance, the capacity development that we do tend to translate in an important outcome in terms of public investment efficiency. What we mean about fiscal framework, there are institutions, is very broadly in the chapter, we touch upon some of this issue. In some countries, we speak more about the issue about control of corruption, governance. In other countries, we speak more about strong medium-term fiscal framework. By strong medium-term fiscal framework, we mean 3 elements. We mean fiscal rule that are sensible, medium-term target, and important fiscal council that we see that in many countries have a significant role to play to make sure that the spending is well planned and efficiently executed. Just to do a bit of advertisement, last month we received a new staff discussion note on the role of fiscal rule and fiscal council. We actually update the IMF database on both sources. Now cover many emerging market and developing economies. So people are interested in this data. They are available on the IMF website. On that dynamics, we hope that countries will not turn to the two things that someone has asked, either monetary debt with inflation or financial repercussions. I tend to be more positive in the sense that what we've seen in many countries is that, for example, some of the reforms that we discussed in the chapter, yes, sometimes are difficult, but actually many countries have done significant improvement in improving efficiency, and these things tend to be sizable. So yes, there are challenges going forward, but I think is our job as economists to remind the potential cost of some of the solutions, but also to try to propose solutions that are also more political acceptable by the policymakers and voters. So I think the idea of this chapter, spending smarter, not let's say to recommend consolidation, but spending smart in the sense, well, we are not telling you to do cutting spending, we're just suggesting countries can achieve higher growth, and means actually can get higher revenue, can lower debt, by spending smarter, improve efficiency, and improving spending composition. So I think this is an important area where the fund is working on and trying to provide tailored policy advice, but also that can have a significant intent more on political acceptability of various of the measures that we have done. We have done some work at the Fiscal Monitor. The WEO last time has also had a chapter on political economies of reform. I think this is an important area of work that we are continuing to push frontiers.
Thank you very much, Davide, for your answers. Now, this concludes our SUERF-BAFFI Bocconi e-lecture on key insights from the IMF's October 2025 World Economic Outlook, Global Financial Stability Review, and Fiscal Monitor. As usual, the trio of reports offers a wealth of data and analysis. I think this has become obvious already from the small appetizers that you offered now. It paints a mixed picture of opportunities, but also multiple stumbling blocks and severe risks. It becomes obvious that the right policies need to be taken to keep the global economic and financial system on a good course. The IMF fortunately points out the direction to go and offers quite concrete advice. Let's hope the gospel is spread and global leaders follow the IMF's advice. Let me conclude with a great thank you to Deniz, Jason, and Davide for your excellent presentation and for answering our many questions. It's comforting to see that competent and reliable institutions like the IMF keep up global dialogue and cooperation among experts and political decision makers based on facts and sound analysis, also in turbulent times. Thanks to all of you for your interest and for your questions and comments. Bye-bye and take care.
Bye-bye.
Thank you. Bye.
Thank you. Bye.
Bye-bye.